So I wanted to discuss a few things and talk about some interesting articles, but I mostly wanted to talk about what I'm doing about the current market crashing situation. It's been a very bipolar market, aka just volatile like all hell. I'm sure if you follow the stock market at all, that is what you have been seeing as well. And also just trying to figure out, like, can you predict what's going to happen in this market, or are you better off just doing nothing, basically? I would recommend most people do nothing. If you happen to have some cash lying around, then now is probably not a terrible time to start putting it into the market. But I'm going to try to do a little bit more of a nuanced take. I wrote a bit of an article over the weekend as well. All right, so this is the post that I wrote. It's called Buy the Stock Market Dip Tariff Mania. And this screenshot, I think, was from Friday when literally the entire market was red. If you look at the market today, things have gotten slightly better. So you can see things are picking up a little bit. The peak, we're down 18%. So not quite bear market territory, but it's getting extremely close, which is a 20% dip in the market. When is the time that you need to think about buying back in? What are some of the things that you need to be thinking about? And that's what we're going to talk about. As someone who likes to purchase stocks and the markets are bleeding, I want to do a quick discussion and talk about how the markets are in free fall. After doing a bit of reading, the net tariffs that the US has imposed are around 22% overall, which is 19% higher than it was last year, and the highest it's been in about 100 years. And I talk about this Motley Fool article, which was really good, honestly. So this was a really interesting data point, and this goes through various points in the history when tariffs got increased. So for example, from 1995 to 7.6% in 1962, it was a 1.7% increase across 7 years. But the S&P fell into 4 corrections and 2 bear markets, the worst of which was a 28% decline. Another example of the tariff rate was 27% decline, 0.6% increase in tariffs. These aren't perfectly correlated, like there were probably other things happening too that weren't just tariffs. It's interesting to see that there is some correlation. And if you're around for 2018 and like around Christmas time, there was this really weird drop in the market. That went down 19%. Anytime in recent history that tariffs have gone up, the market has dropped like by a little bit, by like 1% here, 2% there. The market has dropped around 20% or more. So considering that it has gone up 19% in a week, that indicates that this should, in theory, be one of the worst drops in the stock market that we've potentially ever seen. And this is the big caveat, right? Assuming the administration keeps these in place, which has been hard to figure out. And I think that is honestly the only thing that will change what's happening right now. And it's extremely hard to predict that. I'm quite highly indexed in the US market as a Canadian. I had about 80% of my holdings in the US market. So it has been somewhat painful, but also not really, because most days I just ignore the market and I don't have any plans to sell. But I do have some plans now to diversify a little bit more out of US markets. I wanted to talk about what I did last time. So during COVID, my strategy was take out some loans near the bottom of the market, buy stocks and like buy really stable stocks that have just been devalued a little bit. And I wanted to figure out, should I do that again? The difference is that this time the hyper-globalization of the economy wasn't put as much into question, even though there were supply chain disruptions. As of writing, prime rate for interest rates is at 4.95%. So you'd have to make above a 5% return to justify borrowing money. What I did last time and what I'm planning to do again this time was to purchase Canadian bank dividend stocks. That will accomplish 2 things. It will pay me a dividend so that I do not have to sell. If the market continues to go down, I can just use the dividend in order to pay off the interest on the loans. So I basically have like an indefinite holding period. And if you are choosing a dividend stock to buy, you want it to be a stock that has paid dividends consistently for a very long time. And banks in Canada have for around 100 years or more. And then that will just offset this. And it's also likely, if this continues and the administration does not backpedal, the rates will have to come down a little bit. There has been some discussion about whether or not that will be the case, because if manufactured recession does lead to inflation in prices, which in theory it will and it should, everything locally, at least for the US, will become more expensive. And because Canada is so closely linked as a trading partner, things will likely become more expensive here. And actually, we have already seen kind of an unusual jump in the inflation rate that people weren't really anticipating. But then you have other parts of the market kind of going down, like oil, etc. So it's tough to say if it'll balance out. Prices on goods and groceries and just like day-to-day things will probably go up, at least in the short term, while people try to figure out like new trading partners and supply chains and that kind of thing. There is some small risk that rates do increase rather than decrease. I don't really see that happening in Canada. In the US, I can't say. In the US, I do think it's possible that rates actually go up. And I think that the effect on our inflation rate, if it goes up, will be temporary. Don't anticipate this lasting for too long inflation wise. And I think it'll be more important to stimulate the economy, if you will. It is a risk. Like there is a risk that something happens and inflation goes up and then, your dividends aren't paying off the interest anymore. So let's see what the Bank of Canada was saying about this. I was trying to figure out what were they projecting, and this kind of discussion from February 2025 does a good job of summarizing it. Unlike the pandemic, if tariffs persist, there will be no economic bounce back. Long-lasting tariffs mean lower potential output because our economy works less efficiently. Monetary policy cannot restore the lost supply. At most, it can smooth the decline in demand. So these last two sentences are actually very interesting to understand what they mean. Initially, they are expecting excess supply in the economy as exports fall, as we won't be exporting as much to the US because it will cost a lot. And same goes for importing things from the US. It will probably decline significantly, and we have already started to cut things like certain alcohol producers. This will likely lead to a short-term jump in inflation. Assuming this isn't too bad, we will then have the problem of a lack of demand due to things like job losses, lack of business investment in our economy, which we have already been suffering from, and this will basically make things bad. The governments have been saying that they'll try to mitigate this by providing economic support, basically. The smooth the decline part is the part that's interesting. They cannot restore the lost supply, but they might be able to smooth the decline in demand, which basically just means cut interest rates, which they'll try to balance with the upward inflation pressure, which basically means don't cut them too much. And interestingly, too, the projections from the Federal Reserve and the Bank of Canada were projecting about 3 to 4 cuts in interest rates, and now it's closer to 4. And the Bank of Canada similarly was supposed to have about 3 cuts by the end of 2025, but I think it's possible that we see 3 to 4 as well, and we'll be close to 2% interest rates by the end of 2025. Last time during the pandemic, the reason that prices increased so much is because that people weren't working and weren't spending as much of their money. There were also supply chain issues, which means there were fewer goods to go around. And this was basically the perfect recipe. People having lots more money, government stimulating everything, while there are fewer goods to go around, led to inflation. This time around, the dynamics are different. People don't have as much money floating around. I don't expect the saving rates to just pop. It's going to be in the gutter. And people, even before this, were already stretched. So there aren't as many good jobs around as there was back in 2019 when everything seemed rosy. What this means is that the higher prices will likely just result in less demand for goods. And this will lead to contracting economies and drawn-out recessions. COVID wasn't really a traditional recession. The recovery was unprecedented, and it was very like a temporary shock. This time could be different. And if it stays, it can cause very kind of long-term painful economic damage. Something else to look at was the S&P 500's price to earnings ratio. So if you look at history, what will likely happen to the stock market is a big drop followed by years of a slow climb as the economy adjusts to the new reality. The only question is how far will it drop? And another thing to consider is the price to earnings ratio of the S&P 500. It's hovering around 23.5 as of writing this on Friday, and earlier this year was close to 27. So even at a PE of 23, this is still on the higher end of an expensive stock market. Something closer to 20 would be considered reasonable and a good buy, and I think that as of this week, we are closer to that number. But since these tariffs are likely to decrease consumer spending and cause companies' earnings to fall in the short term, it's easy to see that the stock market might have a ways more to come down based on this alone. So basically, we have not adjusted the earnings side of the equation yet. Even if the price of the stocks are coming down, the earnings are not going to be adjusted for another quarter or so. So the earnings part of the ratio is yet to be updated as we wait company earnings. Earnings won't show up in financial statements until Q2 because we just finished first quarter. The thing is, like, it's hard to say if the market will be able to properly price this in, or if Q2 earnings will lead to another leg down in the market as we see the real reality reflected in earnings. Businesses and companies will probably start to guide down or just delete their guidance altogether and say, like, we have absolutely no idea what's going to happen here. However, as with everything when it comes to pricing in, I think it's likely that the market's going to overshoot to the downside, which is when the buying opportunity should present itself. The only warning is that you should be prepared for a very low and slow climb back up if these tariffs stay in place. The administration and the president change their mind, then it'll probably just be super volatile and it'll shoot right back up. The issue now is that so many other countries are beginning to retaliate against these tariffs that even if the Trump administration decides that they want to stop putting in the tariffs, that like all of a sudden they're like, okay, market has crashed enough. All of my friends have bought into the market. Now we're just going to cancel the tariffs, right? Even if that happens, there's so many countries that have put retaliatory tariffs on the US. The president has been so unpredictable. The trust is just going to be completely eroded from the United States. So I think what's going to happen, and like they've basically pigeonholed themselves here, because even if they decide, unilaterally on their side to cut the tariffs, it doesn't really make a difference because no one's going to trust them, and everybody's probably just going to keep their tariffs in place, which is going to be very bad for the US consumer and for the US stock market. So I think most countries will just leave their retaliatory tariffs on the US, and that's just not going to be fun for Americans because they won't be able to export anything. They won't be able to export services. They won't be able to sell to other countries. I honestly don't really see a reality where even if the administration backpedals, that things will immediately change and that all these other countries will also immediately change. And there are also a few tariffs that are very targeted and specific that even if, they backpedal on the like big whiteboard of tariffs, I don't think they will backpedal on like steel and aluminum, on cars and like energy and a few other things that have actually been targeted for, I think, reasonable reasons, not try to bring in all this low value added manufacturing and basically delete all of our high margin, high value added stuff that we have been building over the past 30 years. And that's the other part that's really confusing too, is like, if you take what they're saying at face value and they want to bring back manufacturing for like iPhones, for example, you won't be able to manufacture an iPhone in the United States for the same price that you can do it overseas, even if Apple does build a factory in the US. And you also won't be able to find people that want to do that work in the US. And you're also trading this higher margin product of like the technology, the design, the like NVIDIA chips that are selling at like a 55% margin to like all these other countries and companies around the world. Now what you're doing is you're trying to bring in-house all of the lower end manufacturing of like basically assembling an iPhone and like all this other stuff. So what you're doing is injuring this like high margin, high value stuff, trading it for low margin, lower value added manufacturing. So you're literally shooting yourself in the foot and going back in time instead of trying to continually improve on the stuff that adds more value to the economy. So it's really hard to make sense of all of this. Like, why would you want to do that? It doesn't really make any sense. If you're one of the most like high-tech countries in the world and you want to bring back like t-shirt manufacturing, like why would you want to do that? It doesn't make any sense. Even the justification of, oh, like we want to bring jobs back to the US. That wasn't really the problem. Like maybe there was a problem with minimum wage and like some other things, but the problem wasn't that there weren't jobs. Sure, maybe there aren't good jobs, but there are different policies you can do other than tariffs in order to try to address those issues. Basically just propaganda with all this tariff stuff. Really good way to just like give China the new world order, basically is what's happening. If you really boil it down, he's forcing the rest of the world to stop trading with the US and start trading with other people, including China, who have been on a solid growth trajectory. Like back in 2011, they were like the 6th largest economy. You know, like 15 years later, they are the 2nd largest economy, and they're on pace, and they were always on pace to overtake the US at some point. But this is really just going to accelerate that. So at minimum, it'll likely be at least 4 years before things change. Again, unless Mr. Orange changes his mind in the meantime. So even if you factor this in for a 4-year bleed, like an economic basically recession for 4 years, I do somewhat hesitate to recommend borrowing money to invest. You know, everyone was stretched quite thin prior to this, and this will completely shake up global trade. Another potential wrinkle is that this ends up being a temporary 4-year policy, and in 2029, everything goes back to pre-tariffs. I would consider this a very likely scenario, but again, with the new information that I've gathered and all of the retaliation that's been going on, I don't think at this point it will ever go back to the way it was. Even if a new president comes in, like they will have so much work to do to reverse this, to rebuild like trade relationships. It's insane. So in the short term, this will arguably make things worse for Americans, as companies will be reluctant to onshore production and invest in long-term plans to build in the US because of the uncertainty of if he'll change his mind, because of the fact that 4 years from now, he will probably be gone. So if I'm going to build a fucking steel plant in the US that takes me 5 years to build, and I know that Trump's going to be gone in 4 years, I'm not going to do it. Like, I'm not going to onshore my production to the US. I'm just going to pay the tariffs or not pay the tariffs and trade with other people. So what this is just going to result in and is people finding other trading partners or just cutting out the US entirely. And this will reduce overall economic activity in and with the US. So the US will certainly see high inflation and job losses due to companies' inability to be competitive globally and export at reasonable prices. Countries start to put reciprocal tariffs in place. It's equally possible, in my view, that this Liberation Day ends up being very short-lived. Once the US begins to feel the impacts of markets falling, it's possible that everyone, including those around Trump in the next 6 months to a year, more like 6 days, start calling for him to revert these policies. If he does reverse course prior to the end of his term or next week, the markets will likely react positively, although they probably won't return to their highs of January due to the lack of trust in Trump. So as an investor, you have to balance the possibility of both of these things happening. It's likely that this will be long and drawn out, but it's equally likely that things will change sooner than later. In either scenario, the US should return to a moderately more free trade policy at some indeterminate date in the future. Since this is almost a certainty, whether it's with this administration or the next, the length of this downturn doesn't necessarily matter if you're a long-term investor and you're buying with cash you can afford to dump into the market. So I think in the future, this is likely, regardless of what happens economically, going to be viewed as a very good buying opportunity. I think it's a safe bet to say for the next 4 years, the US will no longer be viewed as a safe haven for investment. So I would recommend diversifying outside of the US if you are considering buying back into the stock market while things are down globally. Diversify. The European Union will be hit pretty hard by a lot of these tariffs, and especially because China has basically built up their own auto manufacturing base. It is going to cause a lot of pain in the European Union because now they can't trade with China or the US because China doesn't want to buy their cars anymore because they're building their own cars at a much cheaper price. Anyway, the long-term impacts of the US economic dominance due to this policy, lack of trusted trading, intangible things is harder to quantify. Long-term, the stock market in the US trading at a lower multiple than it was before. and the US won't be this kind of like overvalued behemoth that it was a couple months ago. So something you might notice is that in recent years, the volatility of the markets have increased significantly. This is partly due to the speed at which information travels these days. Reaction to world events tend to be more instantaneous than they were 25 years ago. The decline from the dot-com bubble was a 2 to 3 year long protracted fall, whereas COVID decline was, I'm not kidding, 3 weeks. Then the Fed stepped in to save the market and the recovery began. Within about 6 months, it returned to where it left off in February 2022. And between 2022 and 2024, there were some ups and downs with a period of a 20% drop, believe it or not, between 2021 and 2022. But on the whole, things were a little more stable. I wanted to point this out because I think the modern era will play into the speed and severity of the decline. I don't expect the recovery to be nearly as quick as the COVID recovery was, but I think the sharp declines in the market will continue for a couple of weeks at most, and then things will stabilize once all the tariff stuff plays out globally and everyone figures out what their retaliation is going to be. Things will sort of stabilize. But I actually, like, after having read some stuff and sort of looking into it a bit more, I don't think we're in like an era of slow stability. Like, we're in a high volatility moment in time right now, and that goes for both up and down. So on any given day, the stock market could go up 10%, it could go down 10%. And that's crazy, first of all. This makes predicting the bottom like very challenging. You can never really predict the bottom, so I would just recommend to buy in slowly in chunks on days when the market is down over the coming weeks and months. I hesitate to think this decline will be as fast as the COVID decline, but the main event, the main shock has already happened, whereas during COVID, the main event was when everyone realized the spread of the virus was happening. This time it was that big whiteboard that Trump held out. So importantly, to much of the high-tech industry, chips from Taiwan will become more expensive. Tons of supply chains are located abroad, especially in China, and lots of consumer electronics are manufactured in China or Taiwan or Vietnam. With the additional US tariffs, projected lack of consumer spending, you might see companies like Apple drop significantly, which it already has. And I personally am not going to be buying individual stocks. My suspicion is consumer spending will basically halt for a while as people worry about the tariffs and many people begin losing their jobs and no longer have money to spend. On balance, I think borrowing money right now to invest holds a good amount of risk simply due to the volatility. I don't really see a guarantee that things will improve anytime soon unless the administration flips. When we had the COVID downturn, the action of the central banks and governments supported economies rather than taking a chainsaw to them. And there are many more uncertainties this time around. That being said, every time in history that the US market has fallen, things have eventually recovered. On top of this, there is a limit to the amount of time that Trump will be in office for now. There is some talk. Basically, I watched a Legal Eagle video, and he mentioned that it's possible that the Senate, I believe, or the House, that they will try to force Trump basically to reverse this decision because technically they are the ones that have the power to impose tariffs and to write laws. Trump has unilaterally chosen to do that with the executive order, and there's like these emergency powers that the US president has related to economic problems, and he basically invoked those in order to do this tariff thing. Senator Elizabeth Warren released a bipartisan resolution repealing sweeping tariffs. If approved, the measure would terminate the emergency declaration the Republican White House used to impose the trade sanctions, blah, blah, blah. The measure is known as a privilege resolution, which means it must receive a vote by the full Senate, circumventing the upper chamber's usually rigid voting rules. The problem is that they'll have to get the Republicans on their side in order to make this go through. And I just don't see that happening. Unless Republicans join with Democrats and take back Congress's power over trade policy, the damage could take years to reverse. It's a possible solution to this trade war thing, but I don't really think that it will come through. Anyway, the last couple of things here is that the US global dominance is in question. This is the only assumption that you haven't really had to question over the last 80 years. And that's if the US will remain the dominant force once all of this is over. They were riding the high, being the most innovative, powerful force in the world after World War II. The competitiveness of the US on cutting-edge tech and top talent being attracted is genuinely put into question. China was already on pace to surpass the US, currently number 2, and I suspect this will just accelerate the US decline in competitiveness. I'm still somewhat naively hopeful the US will come out of this and be able to resume somewhere near where they left off. There will be people within the country that will continue to be on the cutting edge. Entrepreneurialism will still be at the heart of the US. They will still export a lot of media to the Western world, but it's tough to say whether that will actually end up being the outcome of this. If you look at the United States, like corporate debt, yeah. So if you look at the US corporate debt, this is debt, securities, loans, liabilities. Basically what companies have been doing in the US is issuing debt and stuff to buy back their own shares in order to increase the multiple on the S&P 500. So the national debt of the US has been increasing and has continued to increase to this day. Household debt has also continued to increase, so have defaults. They've used debt to increase asset values. They've used debt for various other types of spending. And if they have no way to kind of keep the economic machine churning, and, you know, consumers, especially in some states, like the levels of default on credit cards, on auto loans, everything is kind of falling apart in the US. And adding these tariffs on top of that already kind of dire situation, I can't imagine that this ends really well. Like this amount of debt on various things and the amount of defaults that you're seeing on like even houses in the US is starting to approach Great Recession levels. And that's problematic. You know, slap some tariffs on top of all of those other problems and you got yourself a little bit of an issue. I think there's still room to fall. The market is down about 15%. Now it's about 18% from its January peak. Considering these numbers are only starting to bring the market back to realistic valuations, I'm not even sure the tariffs have been priced in yet. China announced reciprocal tariffs. Now they're at like 80% and the US's are at like 104% or something. And the US imports over $450 billion of Chinese goods, which have now it's like an 80% tariff, 104% tariff slapped on them. And stocks with large exposure to the Chinese market, like Nvidia, Apple, and Tesla, saw more severe drops than the whole market. Over the weekend and starting next week, it's likely there'll be more retaliation, which there has been. The European Union has retaliated with auto tariffs, and each time another large economy decides to fight back against the US, it'll continue to hurt the US markets more and more. As this builds up, I suspect that Trump will backpedal. Even if he does, no one will trust his word anymore, and the market might just continue its free fall. All right, so as I was editing this video, we got the old yoink and twist. So, bro, this is fucking stupid. Woo, the market's back, baby. What the fuck? All right, so somehow the whole market just got like fucking pump and dumped. So the story goes, Trump pausing tariffs for 90 days. Now, the thing that really confused me, first of all, I'm a little bit annoyed. I was thinking, like now is probably a good time to get into live streaming because there's literally no other way to stay up to date. I was in the middle of making my bloody video and this happened and now my video is completely irrelevant. And I think I say in the video, I'm like, oh, once all of his friends buy in, he'll just flip. And I kind of said it as a joke, and it ended up being true. And he also, I can't believe I care so much about this, but he also posted this morning that like, oh, now is a good time to buy, which is just like the most meme fucking thing to say when it seems like you're out to destroy the entire world economy. Basically ends up doing exactly what he said he would, which, does that make him more predictable? I don't think so, because these were unpredictable in the first place. Anyway, the thing that's crazy about all of this, substantially lowered the reciprocal tariff this period, 10% effective immediately. And then China gets a tariff of 125%. So he lowers the tariff, global tariff, to 10%. I don't know if you remember earlier in the video, there was this, and this talked about how when the tariffs went up 0.6%, The S&P suffered a 27% decline. When the tariffs went up 1.7%, it suffered a 28% decline. What are we doing? Like, it's not gonna help. There's still 10%. There is still a 10% tariff on the entire planet. Okay, and he did say, and like the fucking person who does this like trade stuff, Bassett or whatever his name is, he did say that they would like negotiate with every country that's called them, blah blah blah, and they're like trying to pretend like this was all part of a plan. Why the thing that's messing with my brain is, okay, why is the market doing this? And then I'm thinking like there's no way this is gonna stay, and like if I could stomach shorting the market right now, I would, because 10% tariffs is insanely high still. And if they do work on getting that number down, it's still insanely high. Like nothing has changed in my opinion, but the market disagrees a lot. I'm also a little bit annoyed that I wasn't able to buy in, but I also told myself I wouldn't buy in unless there was a 20% drop. And arguably this benefits me as well since I didn't sell. So, I still have my entire portfolio basically, but I also don't want to miss the next opportunity because there is no way this stays. Like, no shot. Yeah, okay, so this old press secretary dude agrees with me. Even their new regime has tariffs near Smoot-Hawley levels and will cost middle-class families close to $2,000. We're far from being out of the woods. Much credibility has been lost. Be afraid. I am in agreement with this for the most part. I guess he could change his mind on this. It's also just a pause. Like, there's no guarantee. Nothing has changed. This is insane. I think whoever on the internet has said, just don't follow the stock market while this guy's in office, you should probably take that advice. Go live your life. Like, just ignore this. Like, it's just insane, man. With one fucking tweet, you can make the market go up and down 10%. That's crazy. This kind of reeks of market manipulation. Oh man. Well, I forget how much money I had. I think I had a few $1,000s like that I bought in with recently. So I think next time I'm just going to use the leverage that's available to me in my investing account because it's the lowest interest. I'm just sick of this. I think everyone is. And it's probably not over. Like, this is going to keep getting crazier. Anyway, I just needed to add this. I don't know where I'm going to put this. Maybe I'll just make this its own video. But, like, what the hell, man? Time to start live streaming, I guess. Twitch.tv/OliverFoote. Oh, also, another thing you can do is you can view this as an opportunity to get out of the U.S. markets and diversify. It's tough because prior to this, I would have been like, yeah, definitely diversify. And I still believe that you should do that. And there's something to be said for getting out while the getting is good. Anyway, take this as an opportunity to deleverage, to get smarter about your investments. I think what I'm going to do is sell off some of my double leveraged ETFs that I had and then buy Europe. I think that's the idea. That's going to be the diversification plan. But clearly what this shows is that it doesn't really bloody matter because all of the markets are linked. Like, on the 1-day chart, Europe is doing the same bloody thing as the S&P. So, like, does it really matter? I don't know. So, what am I going to be doing? With the small amount of cash I have on hand, I'm likely just going to buy in slowly. I'm going to buy chunks in the next couple of weeks when the drop is closer to 20%. With a clearer picture, I might also take on a small amount of loan risk that I feel I'll be able to pay off successfully if that turns out to be a bad decision. It's also important to consider your stage in life when you're deciding how much risk to take. I am 25. I don't necessarily enjoy taking on huge amounts of risk, but I am young, so taking on a bit of risk and someone who is retired is not necessarily a bad play. Regardless, prudence is important when we're talking about entire economies getting blown up and people losing jobs. So if you're not in a recession-proof job, definitely be careful. Don't really have all that much to lose right now, but I also don't want to be an idiot and lose for no reason. So calculated risks are important, and I think this is a good time to take action and to calculate some risk. That's my analysis of the scenario. Only time will tell what the outcome is, but I'll leave you with the age-old saying of buy low, sell high, and hope the US comes to its senses. We may not be at the eventual low yet, but buying on the way down has proven to be a winning strategy time and time again. And also, as I mentioned, maybe don't buy into the US. Maybe buy into other economies, other countries while you can, and while their markets are down, because they will likely recover a little bit stronger than the US will from this downfall. So don't just immediately jump back into the same thing that has been beating you up, but do buy when things are low, diversify, and hold out for a while, because it's going to suck for a bit. Timing the market is a fool's errand, so be sensible. Don't sell your stocks just because they're down. Honestly, the best thing you can probably do if you have no money and you don't want to take on any risk, just do nothing. Wait until the volatility has passed and then start to make decisions on whether or not you want to diversify. Trump can do a lot of damage, but I believe the US will still come out of this as a top player on the world stage, even if it's not number one anymore. And even if it takes 4 years for all of this to blow over, and even if there are some irreversible problems that are caused, which I think we have actually probably crossed that line already. This time, the decision isn't as easy as it was during COVID, but if you drown out a bit of the noise, buying in while things are looking bad and understanding that this is all most likely temporary is how success stories are built. As always, keep investing. That's my 2 cents about everything. I'm going to be buying back in. I'm not going to be buying into US companies because I'm already quite highly leveraged in the US. So yeah, that's kind of the situation. I don't know if it's going to get any better. I'm keeping my eye on the news pretty closely. I'm trying to buy when things are down, and like I have no idea what's happening in the market. 1 second it's up 1%, then it's down 1%. Now it's up 1.7% while I've been making this video. So I'm like keeping my eye open. I'm trying to see if there's like, some news, something that indicates that the market should be going up, because realistically, fundamentally, if these things stay in place, we have barely seen any decrease in the US stock market. The price to earnings ratio, the S&P 500, was 27, and now it's like maybe at 20. On a good day, like it really should have, like it should probably be trading around what it is now if the market decides to rip right back up because someone flips their mind. So I'm only going to buy in when there's a really good deal. And if I don't feel like there's a really good deal, then I'll just wait it out. That's the situation. Read the Financial Times. That's about it. Thanks for watching. This video is going to suck to edit, and bye.